Coming up, we will be discussing your tax bracket and how to best risk manage and to lower your taxes today, tomorrow, and in the future. Welcome. We are talking about taxes today. Now, I know that that's not exactly a very popular discussion, but knowing where you're at in your tax bracket, knowing how to specifically risk manage your taxes is going to help you today. It's going to help you this year, next year, and in the future. So knowing a strategy and having a strategy in place for your taxes is going to actually make sure that you pay the least amount of taxes possible. That's what we're going to be talking about today, and it all starts with knowing your brackets. You see, there are a number of different brackets, and we have a graduated system here. So if you're in the 22% bracket, you're not going to be paying the 100% of your tax in the 22% bracket. You're going to pay some in the 22, you're going to be paying some in the 12, 10, and then also some of it is going to be tax-free. So with that system there, you have a lot of opportunities, though, to make sure that you are managing your taxes correctly. So the 12% bracket goes up to just over $83,000 married filing jointly. The 22% bracket goes a little bit over $178,000 married filing jointly. And when we talk about even the 24% bracket, that goes up to $340,000. So there's opportunities that you have. Now that's on the income, so that your taxable income then that you have. And why that's vitally important is because we can break down your income into 3 separate categories. Now this is really important to understand. These categories, or I call them buckets, are going to be the essence of the entirety of your taxable plan that you have. So let's start on the one side here. We have what I like to call tax me now. This is basically your taxable income. Tax in the year that you have it. So when we're taking a look at concepts here, that taxable or tax me now bucket is taxable in the year the income is earned. So think about it this way: what you have coming in from your business, whether it's W-2 wages, whether you're taking business distributions, or if you are having anything related to a payout from your business, all of that is taxable in that year. So that's tax me now. Well, you also have long-term capital gains. So you have assets that are capital gains that you have sold either short-term or long-term. All of that is taxable. Well, then we have the tax me later bucket. That is effectively your tax deferred bucket. So I call this your tax me later because it's not taxed in the year that you earn or put money into those accounts. It's taxable later on when you start using that money. So a good kind of example of this is maybe your traditional 401k, traditional IRA accounts. Deferred compensation that you have through work is a big piece of this as well. And some of your defined benefit plans. So your pension plans that you have, whether you have a cash balance plan or just a traditional pension, all of those are taxable later when you start using and drawing the money, not in the year that the money goes into those accounts. So we have the tax me now bucket. That's taxable in the year you earn the money. So dividends, interest, capital gains, income from business. You have your tax me later bucket. Those are, again, the retirement accounts and things that you can be putting money away for the future. But then we have one more bucket here that is vitally important to know about. I call it, effectively, the tax me never bucket. You see, that is the tax-free buckets of money. Think about Roth IRAs. Think about life insurance as part of this as well. Now, there's many strategies here, and the best part of things that you can be considering when it comes to your tax bracket is to figure out how we can manage those distinct buckets. So let's conceptually kind of take a look at this here. First thing that you should be doing is knowing the tax brackets. So that's obviously what we talked about at first. Knowing where you're at in the brackets will help you make the best decisions. So when we talk about the fact that you may have an additional $50,000 within that bracket, well, let's utilize that. So we have the ability to say, all right, well, that tax me now income, let's be using a little bit of that because we have to be. But let's make sure we can fill up that bucket, and maybe we can take some of that income that's in that tax me now and we can move it into the tax me never bucket. So that way the money that you have set aside for the future is actually never taxable again. So once the money is in the life insurance, once the money is in the Roth IRA accounts or your traditional 401k, they sometimes have a Roth 401k provision as well. So you have a Roth 401k. Anything with Roth in front of it is part of that tax me never bucket. So those strategies, then we can say, well, if we can, let's use some of this money for our income. Then we can be using some of this money to put aside for the future that will never be taxed again. And we also have some money that's going to lower your taxes today by basically deferring the taxation. So those three strategies that we have can be important when it really comes back to knowing your brackets. You see, if we are right at the cusp between going up a bracket or down a bracket, maybe we put a little bit more away into something like your 401k or your deferred comp plans to lower yourselves a bracket. Well, that can have a huge impact if we go from, say, the 32% down to the 24% bracket. I mean, right there we're saving 8% on the federal brackets just by knowing where you're at for income for the year. Well, there's other strategies we can do as well. So if we're right on the cusp there, maybe putting money into a charitable remainder trust or donor advised fund. All of those are different strategies in how we can lower your taxes today. So we can keep you in certain tax brackets today. Well, we can also be putting more money into your retirement accounts as well. So that can lower how much money we are paying in tax today. So if we are for sure going to be in a lower bracket in the future, then maybe better to pay, well, some tax today, but deferring more of that money when we know we're going to be in a lower bracket. Okay, so concepts there. So like I said before, maybe it's putting money into the Roth and getting money into the Roth or the life insurance side of things, because that's money that's going to be tax free. But we don't want to be paying more tax today in order to put things away that's tax free than we have to. You see, we can funnel all of that money into the tax-free accounts, the tax me never accounts. Well, that's going to be a really big piece, especially as you're younger. Putting money into those categories are going to be vitally important. But that's not the only place, because that may actually have you be paying more tax today than what you should. So spreading the money out correctly and making sure we have money in those different buckets is going to be, again, vitally important for risk managing your taxes. Well, let's kind of think about this a little bit more than as we think about other strategies. You see, the life insurance is going to be a big piece, because we can obviously have it go to your heirs as part of the life insurance, but on some of the policies that you have, you can actually take loans against it. Those loans that you take out against the policy itself is something that now is tax-free. So obviously there's certain provisions and certain types of insurances that allow for this, but that you can take money out tax-free, and then you can be paying it back in future days, future years, when things have shifted, when your tax brackets have shifted. With your traditional accounts, your retirement accounts, putting money away into those accounts is going to make sure that you can pay less money today, putting money into those types of accounts, but then you're going to be taxed in the future. And for most of you, I'm actually going to argue that you will actually have the same tax bracket or even sometimes a higher tax bracket in the future than where you're at currently. So it actually may make sense to put some more money into the tax, kind of that tax me now bucket, the taxable bucket. So a brokerage account, where we're talking about capital gains. Because when we put money into those types of accounts, remember, capital gains taxes are different than regular tax brackets. So if you are within limits, you may be paying 15% on a long-term capital gain versus a 24% or 32%. The higher you go, then it caps out at 20% versus say a 34%. So this is a great way to save maybe 8%, 10%, 12% tax on every dollar of long-term capital gains that you have. Vitally important to understand that, and that again comes back down to the tax brackets that you have and knowing that. So you can kind of see a concept here that we want to know the brackets and then have the strategies in place. And those strategies are just going through today, mapping out where we're saving and then having a plan in place to be taken from those three buckets. The more you have a plan in place, the more you work that plan is going to make sure that you can keep the money at the lowest possible tax rate today, tomorrow. And whether it's in the future or gifting or leaving a legacy, all of that comes back to, again, the tax brackets. So I hit home on this a lot because those tax brackets are important and those really start to work with everything related to your wealth and your plans. So let's give one more example here. As a business owner, you have a lot of ways you can defer income as well. So maybe you're not taking as much in W-2 income, but you're taking more as a business distribution or draw from the business. Or maybe it's vice versa. Well, that can be the difference between paying a 22% or 32% tax bracket. And what's important to know is that if we take more from, say, like a W-2 income, we can put more away in your defined pension plans. So that could be that we could now put hundreds of thousands of dollars away for the future. That can be a deferral of a lot of those assets as well. So there's some vital important reasons to know your brackets and to have the plan in place. But let's also say that you don't own your business. You've had, stock options granted you from the company over the course of a decade. Well, those stock options are taxable, and a lot of times those are going to cause your tax brackets to start skyrocketing. So what we do then is we take a look at the income you have coming in. So this may be a little Social Security income, some pension income, especially in retirement after you have retired from your company and moved on. Well, maybe it comes back to deferring your pension. Maybe that actually is the best thing available to make sure you can lower your tax brackets. Or deferring Social Security. Remember, Social Security has a different taxation of it as well. And those brackets, everything we've talked about, comes back down to Medicare and your payment of Medicare. So it's vitally important to know this information. But if we want to defer Social Security and take more from those stock options, that actually may be a bigger benefit tax-wise to you. Now, again, it may not be the biggest benefit when we manage and map out the options or some of the other strategies. So I'm not saying that taxes are the only option that we need to consider here, but is one that's going to be important for you and for the future. Now, there's many strategies like this that you can be going through. There's many strategies that are going to be right for you in your taxes. But to know what bucket, whether it's that tax me now bucket, tax me later bucket, or tax me never bucket that your money is going to make for a credible retirement an incredible opportunity for you to gift assets, and also leaving a legacy for your company, your community, and your family. Have a great day, and I look forward to seeing you on future Enriching Wealth times. Take care. Hey, I want to thank you for being a part of Enriching Wealth. Now, for more tips, more strategies like this, subscribe to it, and we can be updating you on a weekly basis of all the best benefits and ways to manage your wealth. Also, there's going to be plenty of opportunities. Click here, and you can be looking at different opportunities to help manage your wealth in retirement as well as part of your business. So with that, I hope you enjoyed our time today, and I look forward to seeing you on the next Enriching Wealth.